Imagine this. You're handed the keys to your forever home. The American dream wrapped in a ribbon of low-interest lies. You sign, smile, step inside, and that's the moment the trap snaps shut. Not just for you, but for 50 million others. Trillions evaporate, jobs vanish like smoke, entire countries teeter on the brink, and the culprits? Not some shadowy cabal in a back alley, but the very banks sworn to protect your money. Suits in skyscrapers, playing poker with your future. This isn't just a recession, this is the greatest financial heist in history, a rigged game where the house didn't just win, it exploded, taking us all down with it. And the flaws baked into the system? They weren't accidents, they were the blueprint for Armageddon. Buckle up, because we're rewinding to 2008 when the world's biggest casino caught fire, and no one knew how to put it out. It started with a whisper of greed back in the late 90s. Picture America, post-dot-com bust, hungry for a win. Enter Alan Greenspan, the Fed's wizard-in-chief, slashing interest rates to near zero. Stimulate the economy, he says. Get folks spending. Banks hear party time. Suddenly, mortgages aren't loans, they're candy. No down payment? No problem. Bad credit? We'll call it subprime and dress it up fancy. By 2004, home ownership hit 69%, a record high. Families like the Johnsons in Vegas bought McMansions they couldn't afford. Betting prices would climb forever. And climb they did. The Case-Shiller Index skyrocketed 80% in 5 years. Flippers turned houses into ATMs, pulling equity like slot machine jackpots. Wall Street? They were the house, bundling these toxic loans into glittering packages called mortgage-backed securities, MBS for short. Safe as houses, right? Wrong. Enter the alchemists, investment banks like Lehman Brothers and Goldman Sachs. They sliced these MBS into collateralized debt obligations, CDOs, tranches of risk so convoluted even the creators couldn't track the poison. Rating agencies like Moody's bought off with fat fees, slapping AAA stamps on junk. It's fine, they lied. Diversified. Investors worldwide, pension funds, European banks, your grandma's IRA, piled in, chasing yields in a zero-rate world. The flaw? Deregulation's deadly gift. Remember Glass-Steagall, the 33 law that kept commercial banks from gambling with deposits? Repealed in '99 under Clinton. Modernize, they cheered. Now, giants like Citigroup could lend to dreamers and bet against them in the same breath. Too big to fail? They were too interconnected to ignore. One wobble and dominoes would tumble. But hey, the party's raging, champagne's flowing. Who sees the storm clouds? Before we hit the crash that made millionaires into migrants, a quick lifeline from today's sponsor. If you're rebuilding after your own crash, maybe a side hustle in real estate or dropshipping dreams, Masterclass can turn chaos into mastery. Learn from titans like Bob Iger on leadership or Sarah Blakely on bootstrapping empires. Head to masterclass.com and snag 30% off with code Magnetix. Because in the game of finance, knowledge is your unbreakable vault. Now let's watch the fireworks. Fast forward to 2006. The party's peaking, but cracks spiderweb the foundation. Adjustable rate mortgages, ARMs, were the velvet hammer. Teaser rates at 2%, ballooning to 12% after 2 years. Borrowers like Maria in Cleveland? Blindsided. Payments doubled overnight. Default spiked 80%. Banks, fat on fees, didn't care. They'd already sold the loans upstream. Enter the shorts. Mavericks like Michael Burry, the one-eyed hedge fund whiz from The Big Short. He crunched the numbers in 2005, spotting the rot. "This is insane," he muttered, betting against the housing market via credit default swaps, insurance policies on CDOs that no one thought would pay out. Wall Street laughed. "Housing never crashes," they sneered. But Burry, Scion Capital, and a ragtag crew including a stripper-turned-trader loaded up. By mid-2007, the bubble popped. Bear Stearns teeters. BNP Paribas freezes funds. Panic ripples. Yet the Fed? They pump liquidity like morphine, propping up the patient. Flaw number 2. Moral hazard. Banks knew Uncle Sam had their back. Post-SNL crisis bailouts taught him that. Why risk less when failure's a golden parachute? Summer, '08. The fuse burns short. Fannie Mae and Freddie Mac. Government-backed behemoths holding half the nation's mortgages hemorrhage $100 billion. Then the unthinkable. Lehman Brothers, the 158-year-old titan, files for the largest bankruptcy in U.S. history, $613 billion in debt. Why let it fall? Treasury Secretary Hank Paulson blinked. Moral hazard, he claimed. But truth? Interconnected terror. Lehman's web snared AIG, Merrill Lynch, the whole grid. Global markets seize. Iceland's banks collapse. Their economy shrinks 10% overnight. UK's Northern Rock runs dry. Queues form like the Great Depression. Credit freezes. Businesses can't borrow a dime. Unemployment? From 5% to 10% in months. Trillions wiped. 11 trillion in US household wealth. Poof. These weren't numbers. These were lives. The Garcias in Phoenix lost their home, their savings, their shot at college for the kids. The system? It rewarded the arsonists. Bonuses flowed pre-collapse, $39 billion at the top 6 banks in 2007 alone. Flaw 3. Asymmetric incentives. Traders got heads, they win paychecks. Tails, we all lose. September 29, 2008. Congress votes on TARP, the $700 billion bailout lifeline. It passes 263 to 171 amid pitchfork fury. Too big to fail becomes law. AIG gets $182 billion, saved from oblivion. GM, $50 billion. But the banks? They pocket the cash, pay bonuses, and lend? Nope. Hoard it. Foreclosures hit 2.8 million in '09. Obama sweeps in, promising reform. Dodd-Frank in 2010. Stress tests. Volcker rule to curb prop trading. A consumer bureau. Systemic flaws get spotlights. Too interconnected now means break it up. But here's the unique twist no doc tells. The crisis birthed beasts. QE floods markets with $4 trillion, inflating assets for the 1%. Crypto booms on bailout distrust. Fintech unicorns like Robinhood democratize trading or gamify it. Fast forward to today, banks bigger than ever. JP Morgan's assets, $3.9 trillion, dwarfing '08. Flaws patched, but not erased. Deregulation creeps back under Trump, then Biden. And the next bubble? Green energy loans, tech valuations, history rhymes. The 2008 heist taught us, finance isn't a meritocracy, it's a machine, oiled by our trust. Burry walked away a billionaire, but for every winner, millions paid the tab. The systemic sins, deregulated greed, hazard without morals, incentives upside down, linger like ghosts. Will we heed the warning or hit replay? If this dive into the abyss gripped you, like and subscribe for more unfiltered takedowns.